This selling puts video is going to be the best video that you're going to watch if you're a beginner, intermediate, or even if you're advanced. I'm going to have some golden nuggets throughout this video teaching you from the ground up, the foundation, what selling a put option is, how to do it, how to make the most out of selling put options. So even if you're not a beginner, I'm still going to have a lot of good stuff for you. Just quick disclaimer, this video is informational, not a financial advisor, just wanted to get that out of the way. So here's a simple definition. A put option is just an insurance contract on a stock. That's all it is. It is essentially a contract between two people. One person is buying the put option, the other person is selling the put option. I love selling put options. They create income. It's one of the biggest and best strategies that I've been using for a very long time. In fact, over a decade now. So selling options is really like insurance. Insurance premium increases when the probability of risk is higher, and the risk is just volatility. So when the market's all volatile and people are concerned, that's a good thing. Here's my portfolio, by the way, and my portfolio has really benefited a lot from the selling put strategy, and we'll go over some of my positions very shortly. But first of all, I just want you to start thinking like an insurance seller. So I don't know if you knew this, but Warren Buffett, he got rich from Geico. That was one of the biggest companies that he had that made him really rich in Geico. Well, insurance money, okay? Just in general, insurance businesses print money. And Warren Buffett is actually a secret option seller. He just doesn't talk about it, but he sells options all the time. And so does his company, Berkshire Hathaway. Selling puts, you basically become kind of like an insurance company, because when you sell a put option, you collect the premium up front, just like an insurance company collects your premium when you buy car insurance or home insurance. They take your money up front, and if an accident happens later, then they have a payout. They pay out part of that premium from the collective pool of money that they got from many, many people. And then they pay a portion of what they collected out, and then they hope to profit from the difference, right? So they collect a lot more, and then they pay some of it out, and then they keep the difference, right? So same thing with put selling. You're just literally an insurance company, pretty much like an insurance business yourself. I'm going to be teaching you how to basically do this on your own on a smaller scale, but you can essentially like print money on a monthly basis consistently by selling put options. And this is a very safe strategy as long as you pick high quality companies, and we'll talk about all of that. So you get paid premium upfront for taking on the obligation of potentially getting assigned. So again, when you sell a put option, you may get assigned the shares. That's like the risk that you take. So you promise to buy the stock at a specific price if needed. So a real world analogy is, again, think about car insurance. Let's say that you pay State Farm monthly premium, right? They promise to pay if you have an accident. So most months there's no accident, so they get to keep the premium. They end up winning. In rare occasions, there's an accident and they have to pay out, but still it's profitable overall to that insurance business, right? So put options work the same way. Stock investors pay you premium. You promise to buy their stock at an agreed upon price. So here's a stock, let's say it's $210. Apple's a bit higher than that, but let's just say it's Apple stock. Here's the market price, and then you sell a put option at $190. Okay, so what ends up happening here is there's the possibilities you can see on the screen. Stock goes up, all good. The stock goes up a little bit, sideways. It's all good. It doesn't really matter in all those case scenarios. You've collected premium and you're good. You don't get assigned, you don't have, any issues, right? But in the case that the stock falls below here, you can see the red arrow pointing to the sell put option contract strike price of 190. If the option goes below, or I should say, if the stock goes below the option strike price, then you will be, obligated to basically fulfill on your promise and buy the stock at 190. If it's at 180, if it's at 170, you still got to buy it at 190. Right? So this strategy is you selling and making money and having to buy if it goes below 190. If it does not go below 190, you're good. If it hits, right at 190, well, you got like a 50-50 chance of getting assigned at expiration. You're usually not going to get assigned early. And we'll talk about early assignment a little bit later on in this video, and assignment and how that works. But for now, nothing's going to really happen if it's even if it hits 190, it's right around there and there's still time left. You should be good in most cases. Only under 190, you have risk of getting assigned. The main thing is when we sell put options, we actually don't really mind assignment because we only sell put options on stocks that we want to own. And this is a genius way of making money, really. It's genius because you get to buy stock for cheaper than its market value and get paid for it. It's almost too good to be true. When I learned about this strategy, I was like, wow, this is what I want to do all the time, right? So most times the stock stays up and you get to keep the premium. Sometimes the stock may drop and you have to buy the stock at a discount, which is really not a big deal. So here's how it actually works, and here's the basic setup. First, you just choose a stock, right? It could be Apple, it could be Microsoft, Tesla, Nvidia, Palantir, SoFi, any of the stocks that I like. And you guys see if you're subscribed, there's a lot of stocks that I've been loving and making a lot of money on. But any of those stocks will be fine. Basically, selling a put option is step two. You just have to pick a strike price. So you pick a strike price, you choose the price below the current market price, right? So if SoFi is at 25, you can sell a put at 24 or 23. And this is basically where you're saying, hey, I'm going to buy it at 24 or 23 if it were to come down to that price, right? Here's Apple. So when I made this presentation, not even that long ago, I was making this presentation and I paused on making it because I got busy with coaching. I had several students that I was really busy with. We're scaling up. Times have been really good in the stock market. I didn't get a chance, but here's Apple. It was at 202, a couple of months ago before I got really busy here. And you can see that essentially here is the option chain, right? So you get paid less, but it's safer when the option's out of the money. So you can see here the 195, 190, like 160. 160 is going to be worth a lot less, and that's just because simply it's farther away, right? So it's a lot farther away, so it's going to be worth less. Versus if Apple's at 202, the 200 put is going to be worth a lot more. It's worth here $5.55 versus an option that's out of the money. It's worth almost nothing at all, right? So the deeper in the money you go, the more you get paid, but also the riskier it is because you will have a higher chance of getting assigned. Now, step three is just really you collect premium immediately. So as soon as you sell a put option, you get cash in your account, and money hits your account. You can go ahead and spend that money on whatever you wish, right? You can withdraw it from your account, but your account value is not going to go up because you still have a negative position in your portfolio. You have sold the put option. To buy it back, it would cost the same. If you were to do it within a short amount of time, it's going to be about the same, right? So let's go over another breakdown here of Apple or really whatever stock. I just want you to understand this on a deep level. The stock's at 200, you sell a 190 put option, 30 days out. Let's say you collected $600 in premium. There's really only two possible things that can happen. It can either, in the first case, it'll stay above 190, right? Here's the case, it just stays above and it even goes up. It can go up or it can go sideways. It stays above, so your option will basically expire worthless. So at 30 days, nothing really happens. You get to keep the entire $600 premium. There's no obligations to buy anything. Now, outcome two is the stock drops below 190, so you must buy 100 shares at 190. So if you have to buy it at 190, if it's at 184, then you'll break even since we collected $6 here. So your real cost here is only going to be 190 minus 6. Because we collected $6 per contract, right? So 184 per share, right? So in this example, you got Apple at a discount, plus you get to keep the premium, right? So you get to buy the stock cheaper and you get to keep the premium. So it's really, really amazing. So why this strategy has the potential to work is really the math is in your favor. Obviously, it doesn't mean that this is guaranteed. Nothing in life is guaranteed, and this is definitely not always going to be profitable in all periods, because what can happen is the stock market could come down lower than your strike price and lower than the premium that you make. But again, I mean, if you like the stock and you were going to buy it anyways, well, you are better off. So this strategy is very powerful in good or bad times. It's really a very stable earning strategy that I would say is good in almost every market. So most put options expire worthless. And that's especially true the lower you go out of the money. In low delta, then it's very low. You can see this chart right here. All those nervous moments that you've ever had as an investor, even if you've been investing for 40 years. There has never been a time, actually, where if you would have bought and just held the S&P 500 index fund, that you'd be down today. You could have bought any time in your whole lifetime or anyone's really lifetime. The stock market always goes up over a long period of time. So as long as you're using smart strategies, either buying and holding high quality stocks or using selling puts to get in, as long as you're using the strategies safely, I mean, selling puts is a safe strategy. It's one of the safest option strategies. It is really difficult to lose money. It's actually very difficult, right? So you really only lose a lot when there's like a huge crash, right? So like the stock market crashes. But since that's not predictable and it's not possible to predict the stock market anyways, and it's a random game, which is why it's like pointless to watch a bunch of videos on the stock market. It's better to learn option strategies so you know how to use strategies. That's way more important. It doesn't really matter. You can't predict the market. So selling puts is pretty much always a yes, unless you really want to time the market, but that's already on you. That's not something that I personally do. All right. So you will lose sometimes, and it doesn't really matter since you're still going to be winning over the long term, and quality stocks usually recover over time. So here's the game plan. 30 to 45 days until expiration is my favorite. There's a perfect balance of premium collection, not too much management, so you don't have to open and close positions like way too often. Some prefer weekly expirations for more aggressive premium collection. I think that's okay. A lot of my newer students, they go for weekly trading. I always tell my students, that's fine. As a beginner, that's okay. But longer term, you want to go for more of that monthly income, as it's less time and less management. So again, the whole goal is just to build consistent cash flow, and selling puts is the best strategy for just having really consistent cash flow. And it's a very versatile strategy, and it's a value strategy where you get stocks at a value. And I think it's the that and covered calls, which I have a course on as well here for free on YouTube. Just type in Invest with Henry covered calls. That's really the best strategy there. So I want you to understand the risks a little bit more, which there really isn't that many risks. But the golden nugget is just look at the worst case scenario. What's the worst that can happen? And it's that you're obligated to buy at the strike price, right? So $50 stock, you sell 45 put. I mean, worst that happens, you have to buy it at 45. But look, the worst that happens to an investor is they go from 50 down, you go from 45 down. So you got to look at other people and you got to compare yourself, and you're going to always be doing better with the selling put strategy besides a bull market. So the actual risk is not that the market goes down. So if you're afraid of losing money, selling puts will always be better than stocks. Always safer in terms of drawdown risk. The real risk to selling puts, and this might be interesting for you to think about, it's not that the stock market goes down. Okay, because selling puts, everyone else goes down more. You go down less. Selling puts is safer. That's why options can be safer than the stock market. Selling puts is safer. It's a safer strategy because you have a margin of safety and a cushion. Stockholders start going down immediately. You start going down a little bit later if you're out of the money, right? The real risk is when the stock market goes up a lot. So if it goes up, you don't participate with all those big gains. So a sell put, whatever you've collected, that's all you can get. You're not going to get any more. So that's really where opportunity cost comes in. You can see on the screen here, it's basically you're letting go of some of the potential. You don't always get all of that potential. So you sell Apple, a $200 put, you collect 600. Apple drops to 180 at expiration. You buy it at at 200. You'll have a loss, right? Because Apple went down, but you won't lose. So this is on the downside. You don't lose as much as an investor does, because an investor loses $2,000, you'll lose $1,400 because you've collected $600, right? So risk management wise, you're always going to be doing better than just a stockholder on a down market. So you really only want to do this on high quality stocks, because when it goes down, you don't want to be worried. You want to be like, hey, I'm cool with that, right? You don't want to be invested in like meme stocks, like a MicroStrategy or a Mara. You don't want to do that, right? Now, in terms of position sizing, for this strategy, you want to sell puts. A general guideline is just to never really risk more than 5 to 20% of your account per trade. I mean, just go in reasonably, right? Some of my positions can get a little bit bigger. Here is a really short-term trade that I did on QQQ here. I did a 0D trade, and that's like a short term. So kind of like fun fact here for more advanced traders, there's weekly, there's monthly, and sometimes there's even 0DT, the same day expiry. This is something that takes a lot more management. It's it's a bit more I guess risky, because you can get assigned very easily in one day, of course. But this is also a viable strategy that I personally use from time to time. And here you can see that I just sold this yesterday. This is expiring on I'm recording this on a Thursday, so this is a non-traditional expiration. It's just a daily expiry, and I collected $1,200 so far in one day. So that's really nice. I mean, yeah, it's a good return to have. Daily $1,200 is like times 30. It's like $36,000 a month in income. Pretty good stuff, of course. So yeah, I have a little bit of sell puts on Robinhood, 110 sell put. I sold this very, very recently in my Discord community as well. Palantir, I mean, you can see here I sold the 135 put. 160 put. I mean, everything's going very well. These are the positions that I'm personally just opening up in Discord. I say, hey, this is what I'm doing. Take a look at it. And I have my live coaching sessions. And if you're interested in that, it's the first link in the description. But yeah, that's as simple as that. Let's keep going on here. When you sell a put option, you are just reserving the capital to potentially buy the stock at the strike price, right? So here's kind of like a little bit of scenario analysis. If you have a smaller portfolio, with 10 to 50,000, 50,000 is not small, but you can go up to 20% of your capital allocation, because you have a smaller account, you can put in a little bit more into each trade. And as you kind of scale up 50 to 250, you can see here, I don't really recommend putting in more than 10%. And then when you have like a much bigger portfolio, you can start taking that number down even less than 10% down to something like 5% per position. And that's just good risk management and good position sizing for you to use to really just be super safe. Your portfolio will not have any big swings at all when you have a lot of stocks. Of course, if the stock market doesn't have like a crash, right? Now, let's talk about the Greeks. The first Greek is going to be delta, and this is the letter that option traders use to measure how much an option's price will move for every dollar that the stock moves. So an option with a 30 delta means, let's say it's on SoFi, it means when the stock moves by $1, that option will move by 30 cents. So this also technically means that there's about a 30% chance that a 30 delta option will go into the money by expiration. There's like two definitions of delta. It's how much the option moves, and it's also the chance that the option will expire in the money. So 30 delta means there's a 30% chance of the option expiring in the money. The complicated math is really behind delta is not really that important. It does change a little bit, but I'm not going to go into the complexities of how that changes right now. It's not that important, right? Now, just pay attention to the number, and from there, you're really just going to see what your chances are of getting assigned. So I recommend 30 delta, but if you want to go safer and you have a lower risk tolerance, then a more conservative number would be 20 delta and below. And the advantage of that is it's safer. The disadvantage of that is it's lower premium, right? So medium delta is 30 and aggressive is really 40, right? An advantage of higher delta is, well, there's high premium, and the disadvantage is it's riskier. Now, the time decay, when time goes every day, it's your friend, really, because when you're selling options, they decay, they lose value. So it's good because you sell them high and then they lose value, and then you just buy them back low or just let them expire completely. And here's a chart of how time decay works. It especially speeds up in the last 1 month. It especially speeds up. So when you sell, time decay works for you, and it gets faster as the time approaches, and its acceleration peaks within that final 30 days. So that's that. Now, I wanted to go over a live example here in my portfolio, but real quick, I want to talk about assignment, and then we'll because assignment isn't that long of a discussion. You don't really care about assignment at all since you want to own the stock anyways. But I just want you to watch this 1 second clip where I make a drawing of how assignment really works. Here's exactly how to tell if you're at risk of being assigned when selling a put option. So let me illustrate how this works with a chart. Let's say that you're selling a put option 100 days until expiration. The bottom of the chart will represent days, and the left-hand side of the chart will represent delta, which is essentially a scale of how likely you are to get assigned on a scale of 0 to 100. And we're showing right now a line of assignment risk. You see how the assignment risk goes way up as the days are approaching 0. Your safe zone is right here. This green area is from 100 days and beyond. You're very, very safe. Now you see here is your moderate zone. The moderate zone really starts to happen in the final month, especially in the final 2 weeks. See, if delta is high, there's still a lot of time left. It doesn't really matter. Your assignment risk is still very low. However, if delta is 50 or higher, in that range, it starts to become moderate, especially in the last 2 weeks. Now you see here the risk zone. The risk zone where delta is, say, 60 to 100, that's where your risk starts to really go up. So, for example, if you have an 80 delta option and you have sold a put and it's 80 delta and there's only 3 days left, you are definitely in the risk zone and your chances of getting assigned might be 50% or more. All right, so now that you have seen what assignment looks like, let's go over a real example using my portfolio. So I have sold here on QQQ put option, but we can go through and take a look at a stock that we may want to sell a put on. The first thing I look at is the market and each stock, if a stock has fallen, because if a stock goes down, that's actually a good thing to sell some put options on it, because essentially volatility is increasing and the stock's already getting cheaper, right? So if it's getting cheaper, that's a good thing, right? Here's Netflix. Netflix is down a lot. Now this is going to be a more expensive trade since Netflix is not cheap by any measures, but I'm just going to show you an example here that, here's Netflix. It's coming down a little bit, right? And it's not as expensive as it was, $1,300. So for example, I can go here to trade options, and then I'm going to sell a put option on Netflix. Now I do have some cash and capital in my portfolio, so I don't think Netflix is a bad company, and this option expires in a very short amount of time. Again, I usually go for several weeks, but I have some extra cash right now. I'm just going to show you an example of what selling a put option looks like. This is not best practice to go very, very short term unless you have a bigger portfolio. If you have a smaller portfolio, just stick to the weekly and monthly options. But here we go. I'm going to go down here. I'm going to click this option. It's a 10 delta. Now, I talked about 40 delta aggressive, 30 sweet spot, 20 and under being super safe. So I can literally just go for something like 20 and under. This is a 12 delta, that's 20 and under. So that is safe. It's not a lot of money, and I am not really risking a lot. This says the risk is that, but that's not really the risk. There really is no risk because I want to buy Netflix. Okay, so there's pretty much no risk. The risk is I can get assigned 100 shares of Netflix. I don't mind, so I'm gonna go for it. I'm gonna do one contract here for this video, but this is a trade that is super easy that I don't really even need to be concerned about, right? So I'm gonna go for 142 in terms of premium collected, and I'm just gonna go ahead and oh, look at that. Robinhood increased the regulatory fee. It was 3 cents, now it's 4 cents. So Robinhood became a little bit even more expensive. So yeah, I submitted this trade. It looks like the liquidity is not that good. The bid-ask spread did change a bit, and it went down a lot. So it went down to 128. So I'm actually not going to execute this trade. Not that it's that big of a difference, but it just makes the trade less attractive, right? I wanted 142, and it looks like the bid-ask spread is just not that stable. And that's fine. I always talk about this, guys. Bid-ask spread is very important. You want to trade liquid stocks that have a lot of volume. This option specifically does not have a lot of volume, and the bid-ask spread is a bit wide at 134, 164. So let me go to this right here, and the bid-ask spread is still wide. So I won't make the trade as wider the bid-ask spread, the more money that you kind of lose in that transaction in terms of transaction cost. But you get the point. You can do this on American Airlines, on SoFi, on HIMS, on really whatever stock that you want to own for a discounted price.